Again, welcome to the Individual 401k Plan and Real Estate Investing Basics. And again, this is a basic course. This seminar is designed to last approximately 40 to 45 minutes long. But if you do have any questions, please jot those down because we're going to open up the phone lines later on in this particular session to answer any questions you may have in regards to the material presented. Again, my name is John Paul Ruiz, the Director of Professional Development here at the Entrust Group. Now, to start off, I just wanted to point out that the Entrust Group does not provide investment advice or endorse any products. All we're trying to do is educate the end user in regards to the retirement plan basics, that as they enter into these types of retirement plans, they would know the basic fundamental information that they would need to know to not only establish a plan but also run the plan. But ultimately, the end user should consult with their attorneys, accountants, and or financial advisors in regards to the type of investment they're entering into, as well as any tax questions that they may have in regards to the retirement plan that they are availing of. Before we dive into the material, talking a little bit about the Entrust Group, we've been around for over 30 years, and we process around 12,000 to 16,000 transactions every month. We are a record keeper. In other words, we provide a platform for individuals who would like to avail of the retirement space and using their investments to invest in alternative investments, such as real estate, which is one of the focus of this particular course. We do have over $2 billion of dollars in assets under administration. Our staff, one of the things that we tout out there is that our staff are vetted out and accredited. In other words, a lot of our staff, if not all of our staff, have gone through some sort of higher level training, and some have actually seeked out the designation called the CISP designation, which is what we call the Certified IRA Service Professional designation. Other staff members, including myself, also holds other designations in the retirement space, such as designations provided by the American Society of Pension Professionals and Actuaries. Our educators, or our individuals that provide these seminars, provide seminars that are eligible for CE programs or continuing education programs for certain designations such as CFP and other designations, well-known designations out there in the industry. Well, enough said. What we're going to try to cover today are the basics in regards to individual 401k plans. We're going to define what an individual 401k is, the eligibility requirements and the deadlines to establish, as well as define who is eligible to establish an individual 401k plan, the benefits of an individual 401k plan as it relates or as it compares to other types of plans, what are the responsibilities associated, as well as the roles individuals play in establishing as well as maintaining an individual 401k plan, what types of investments, and in this case mainly focusing on real estate, how does that work under an individual 401k plan, and maybe what are some of the advantages? Lastly, we'll take a look at how to open up an individual 401k plan with the Entrust Group. Now, what is an individual 401k plan? Well, an individual 401k plan is nothing more than a regular 401k plan allowed under the tax code 401A. For those of you who like to read tax code, it's 401A of the Internal Revenue Code. As you can pretty much take a look at that code, it is alphabetized as far as the provisions are concerned. 401A defines what a qualified retirement plan is. And as we go through A, B, C, D, E, F, G, H, I, J, K, K means it becomes a 401k plan because of a particular contribution that can be made called a deferral. Now, where did this term individual 401k come into play? 401k plans have always been accessible to a certain group of people. Mainly what we're going to try to focus on are entrepreneurs. In other words, people who just work for themselves without any employees. Owner-only plans, as the IRS would call it. Owner-only plans, meaning they only employ themselves, their spouses, or other partners, meaning that they don't have any rank-and-file employees, have always been eligible to establish a 401k plan. However, it was not feasible for some of these organizations to establish a 401k plan based on the limitations on what you can actually deduct from the contributions that are being made. This time frame that I'm talking about is prior to 2002, prior to the passage of a law called EGTRA. The Economic Growth Tax Relief Reconciliation Act changed the playing field in regards to the 401k world, making the 401k plan feasible for entrepreneurs. In a 401k plan, again, there are two types of contributions that can be made, one of which is a salary deferral. In other words, it's a cash or deferred arrangement. If somebody had an employee, an easy way to explain it is, do you want to get paid in cash, or do you want that payment to you to be deferred into the plan? And of course, if it's deferred into the plan, then it's not received by the employee, therefore it's deferred from taxation. In other words, taxation is postponed because the person never received it. That's the first type of contribution that can be made in a 401k plan. Another type of contribution that can be made in a 401k plan is what we call a profit-sharing contribution. Now, of course, depending upon whether or not an employer may have or not have profit will determine whether or not an employer will make a profit-sharing contribution. The maximum profit-sharing contribution that can be made into a plan currently is up to 25% of all eligible compensation. So in other words, if somebody makes $100,000, they can contribute up to 25% of their compensation as a profit-sharing contribution into the plan as an employer and use that as a tax deduction. Now that sounds like a large dollar figure. It is because of the law that changed in 2001 called EGTRA, effective in 2002. Prior to 2002, the maximum deduction or maximum contribution rate was only 15%. 15% of all covered comp. In other words, in comparison to what we have today, in the past, 15% already used up all that the employer can contribute to the plan. Because along with the profit-sharing contribution, that 15% also included the amount of deferrals that could actually be made and be used as a tax deduction under a 401k plan for an entrepreneur, like a sole proprietor, or maybe even a partnership where there's only partners involved. There was a limitation on what can be contributed. What changed in 2001, effective 2002, was basically what I just gave you, which is the 25% deduction limit. Not only can they contribute 25%, which has been increased from 15 to 25, the deferral amount that can be made by the individual is not included in that 25%. So in other words, not only can they contribute up to 25% of compensation as a profit-sharing contribution, above and beyond that, they can also defer the maximum amount. Now, what changes, what differentiates an individual 401k plan from a regular 401k plan again? Again, an individual 401k plan is designed only for owner-only types of plans, meaning that employs only owners, their spouses, and or other owners. In the event of a partnership, partners are the only ones that are actually employed under that particular employer. You may also have some employees, and as long as they're not eligible to participate in the plan, you may still hold an individual 401k plan. Again, if you are a sole proprietor with no employees other than your spouse or partners, if you're also looking for the largest potential contribution for a business without employees, and if you also want the flexibility to invest beyond stocks, bonds, and mutual funds, in this particular example, using the Entrust Group as your platform, you can invest in real estate, as well as other features such as you can borrow from your employer-sponsored plan, then the individual 401k plan might be right for you. In comparison to other types of plans, such as your SEP plan, Simplified Employee Pension Plan, which is basically a straightforward profit-sharing contribution of up to 25%, which does not have the deferral component, we obviously know that the contribution in that plan, that's just by that example, is a lot less than your individual K plan. Other plans also, such as your Savings Incentive Match plan, your simple plans, do not get up to the larger contributions you can make in an individual 401k plan because the deferral limits are a lot lower, as well as the employer contribution is a lot smaller. Again, if you're a sole proprietor with no employees, in other words, you don't have any rank and file employees or partnership, or maybe even a corporation that doesn't have rank and file employees, this is the plan for you. One of the distinct differences between an individual 401k plan and a regular 401k plan is that the moment you have rank and file employees that are eligible to participate in the plan, it subjects the plan to additional requirements, such as what we call non-discrimination tests. Non-discrimination tests are tests that are imposed on 401k plans that have rank and file employees. If you get anything out of this course, focus on that. An individual K plan is not subject to testing or non-discrimination tests. Why is that? Because if you don't have any rank and file employees, what are you going to test on? Again, although 401k plans are subject to testing requirements, the individual 401k plan, again, is designed for sole proprietors or businesses that do not have rank and file employees. Therefore, you're not subject to those particular tests. Some of those tests may lower down the contribution limits by the amount of contribution the rank and file employees contribute. In other words, their level of contribution may dictate what the higher-ups or the owners can contribute. And in this plan, those limitations do not apply because, again, this is designed for those employers that do not have rank and file employees. In this particular scenario, if you have an employer that doesn't have any rank and file employees and they're not subject to the limitations, then the maximum contributions apply without any hindrances. Now, who is eligible again? Let's give you a rundown on the types of employers that can establish an individual 401k plan. Now keep in mind, there is one plan and there are multiple individuals that can actually participate in it. In this case, all owners. Again, the owners, their spouses, or other owners, but never rank and file employees. These are your sole proprietors, partnerships, some other entities such as a limited liability corporation, which could file as a sole proprietor, partnership, or in some cases, if they apply for a special tax filing entity, they may also apply as a corporation. And lastly, another definition or another description could be family-owned and operated businesses. In other words, they only employ the owner and spouses or family members that are not eligible to participate. Eligibility requirements. What does that mean? Typically in a 401k plan, you have to have worked for an employer for a certain period of time, such as 1 year. That is what we call the service requirement. There is also an age requirement that can be imposed in these particular types of plans. The maximum age, of course, is age 21. Now, depending upon the type of document that you use to establish the plan, some of these requirements are eliminated. In other words, anybody who is employed by that employer may be eligible to participate, so watch out for that. Because the moment an employer hires an employee and there is no age or service requirement, then that could subject the plan to no longer being eligible to have an individual 401k plan, but what they have now is a regular 401k plan. But for all intents and purposes, if a business has employees and they're not eligible to participate by virtue of what was elected in the document, meaning they have an age requirement of age 21 and a service requirement of at least 1 year, then they could prolong the eligibility to establish or maintain an individual 401k plan. But again, the moment those employees become eligible, then that employer might want to consider another type of plan because now the plan will be subject to non-discrimination testing. There are also employers that may also employ union employees. If they employ union employees and all of their rank and file employees are union employees, they could still have an individual 401k plan because those individuals are excluded from participating in the 401k plan an employer established. An employer may also employ non-resident aliens with no U.S. earned income. In other words, if individuals who have a working permit to work in the United States are excluded from the plan because they don't have any U.S. source of income, well then the individual could still have an individual 401k plan because technically you don't have any rank and file employees. Again, watch out for things as age requirements and service requirements, and depending upon the type of document that has been established by the employer, Some of these could be applicable, some of them could not, because depending upon the document, again, would define the requirements or provisions that could be applied to the plan. There are, again, certain groups of people that could automatically be excluded, such as your union employees that are covered by a collectively bargained plan, as well as non-resident alien employees that do not have any U.S. source of income. Now, when we start taking a look at the maximum contributions to an individual 401k plan, there are limitations. I mentioned one of them already, which is the maximum profit sharing contribution of 25%. Let's take a look at an individual or a business, in this case Matt, sole proprietor, earns $100,000 of income for the year. For simplistic purposes, let's just say that this is a W-2 income. The maximum contribution that Matt could make is not only the 25% of his income for a profit sharing contribution, as you can see in the second part of that chart, profit sharing contribution of $25,000. Above and beyond that, Matt could also contribute a deferral amount of $17,500, which is the maximum contribution for 2014. Now, in this particular scenario, we are assuming that Matt is not age 50 and over. Why is that? Because there's an additional contribution called a catch-up contribution that Matt could put in above and beyond the $17,500 if he is 50 and over. But for simplistic purposes, let's assume Matt is under age 50. In this particular scenario, not only can Matt put in $25,000 of a profit sharing contribution, he can also defer up to $17,500, since this is a 401k plan that incorporates that cash or deferred arrangement type of contribution. Now, in some documents or in some programs, there are also additional contributions called after-tax contributions. Now, keep in mind, after-tax contributions cannot be used as a tax deduction. That's why it's called after-tax. What it does allow for an individual to do is, above and beyond the profit-sharing contribution and deferral amount, as long as it doesn't exceed another limit that is that 401k plans are subject to, it's called a 415 limit, which is where we get that $52,000. An individual could make an after-tax contribution, assuming, of course, that the plan allows for it, to get up to a dollar figure to get up to that $52,000. Now, this might sound confusing, but again, we're just trying to expose you to the maximum or the types of contributions to maximize an individual's opportunity to bank away as much as they can in a retirement plan. Why is that? Because although some contributions may be used as a tax deduction and some may not, the earnings on these contributions under a retirement plan do grow tax deferred. In other words, the earnings do not get taxed until you take it out. And that's one of the incentives why an individual 401k plan might be an attractive type of employer-sponsored plan for certain entrepreneurs. Why is that? Because again, the earnings do grow tax deferred, and the more assets you can put in there, of course, the bigger amount of earnings that you can have in these retirement plans growing tax deferred. Again, things to watch out for. The employer must watch out for the document to make sure that after-tax contributions are allowed into the plan if they want to make that additional contribution called an after-tax. But for all intents and purposes, if it's just a regular 401k plan, even though it doesn't allow for after-tax contributions, the maximum profit sharing is 25% of compensation, along with a maximum deferral amount up to $17,500, assuming, of course, that the compensation of the individual will support it. The deadlines for establishing an individual 401k plan. There's pretty much a cut and dry, straightforward deadline. The deadline for setting up an individual 401k plan is the employer's, the end of an employer's fiscal tax year. So for a calendar year plan, it's December 31st. What does that mean? It means that the employer must have had a document signed by December 31st if it's a calendar year plan. And for some documents that are used to establish an individual 401k plan, it requires that all these plans must be on a calendar year plan basis. But there are some documents out there that could allow for a different fiscal tax year plan. Contributions for these plans must be made by the employer's tax return due date plus extensions. Now keep in mind, don't get that confused by the establishment date. The establishment date means the document must be signed, as in this case, if it's a calendar year plan, by December 31st. But contributions do not have to make it into the plan up until the employer's tax return due date plus extensions. So let's quickly review what those deadlines are. If it's a corporation, then it's March 15th. If the employer files for an extension, then it puts them at September 15th, which is 6 months after March 15th. If it's a partnership or a sole proprietorship, the deadline is April 15th, which is the individual's tax return due date. And if it's a partnership, they typically give them 5 months if the employer applies for an extension, which puts us at September 15th. And then if it's a sole proprietor, in other words, they file a Schedule C, they typically, again, have 6 months from their tax return due date of April 15th, which puts us in October 15th. So these are the deadlines on when the plan must be funded. So for example, if somebody had established an individual 401k plan for 2013 and they are a sole proprietor and they applied for an extension, then October 15th would be their deadline to make that contribution, which would be tomorrow in this case. Now, people that are sole proprietors that also would like to make their deferrals can also make their contribution up until their tax return due date plus extensions. However, there's a distinct difference between a sole proprietor and a C corporation. If it's a C corporation in which the employees, in this case it's only the owners, that are receiving wages, their W-2 wages must be contributed no later than the 7th business day after those dollars are taken out of a person's paycheck. As you may recall, one of the components or contribution components in an individual 401k plan is what we call a deferral. In other words, not only is the owner, but they're also the employee. If they're receiving a W-2 wage, let's say every 2 weeks, the contributions called a deferral must be taken out of their paycheck in that payroll time period. So in other words, instead of paying themselves a paycheck, the deferred amount must be contributed to the plan no later than 7 business days after that amount is taken out of their paycheck. So for that purpose, now that you've been exposed to that, check with your payroll provider. If you are a C Corp and pays yourself a W-2 wage, in regards to how do you facilitate that process of taking your deferral out of the paycheck and actually deposit that into an individual 401k plan. But if you're a sole proprietor, you can make both the deferral and the profit sharing contribution by the tax return due date, by your tax return due date plus extensions. Now let's take a look at the benefits of an individual 401k plan. Again, the contributions in this type of plan is much larger than your other types of employer-sponsored plans, such as your CISPs and your Simples. The maximum contribution is up to 25% of an individual's compensation for the year, not to exceed 100% of your income, because keep in mind there's also the deferral portion. You might be able to contribute 25% of $40,000. And in addition to that, $17,500 for a deferral. But the moment the income starts decreasing, well, then you may not contribute the full amount because of by virtue of the amount of compensation that you receive for the year. As you run the numbers, it should never exceed 100% of your compensation. However, in determining the maximum contribution, there is a compensation cap used to determine the profit sharing contributions. In other words, somebody who makes $500,000 may never contribute more than a certain dollar figure, or may not use income that they've earned for the year in excess of a certain dollar figure. The compensation cap is $260,000. Uncle Sam says, well, allow for you to bank away into an individual 401k plan, but there's a limit in the amount that you can contribute. If you may recall, I gave that $52,000 as a dollar figure that can never be exceeded for regular contributions into an individual 401k plan. Again, for all intents and purposes, this seminar is just the basics. Please consult with your tax advisor in regards to the maximum contributions that can be made based out of the type of employer you are and the amount of compensation that you're receiving. based out of your entity. Another benefit of an individual 401k plan is that you could take out a loan or borrow from the assets that you have in an individual 401k plan, and as long as you repay it back at least on a quarterly basis and never to exceed an amortization schedule of 5 years for regular types of loans, you can do that in an individual 401k plan without violating any rules. Unlike an IRA type of retirement plan where you cannot borrow from, an individual 401k plan does allow for loans. Keep in mind, again, you have to pay back the loan at least on a quarterly basis, never to exceed an amortization schedule greater than 5 years, unless you're, of course, borrowing from your 401k plan to purchase a principal residence. Purchasing a principal residence does allow for an amortization schedule of up to 30 years, which is common in the industry. But regular loans can never exceed 5 years and must be paid back on a quarterly basis. Failure to pay back your loan from a 401k plan would constitute what we call a deemed distribution. A deemed distribution means that the amount that you borrowed will now be taxable and subject to a penalty depending upon how old the individual is. So there's careful consideration, although this is a benefit, there's careful consideration whether or not you would want to avail of a loan, because there are repayment structures that have to be satisfied in an individual 401k plan. Now let's take a look at some of the responsibilities of individuals in an individual 401k plan. In an individual 401k plan, it's the trustee that is responsible to provide instructions to buy or sell investment. This responsibility may also be given to the participants to buy and sell their own investments. And in this case, all the participants are either the spouse of the owner or spouses of the owners or the owners themselves. They must also perform their own due diligence in regards to the investments that they're entering into. If somebody wants to buy a piece of real estate, in our scenario with the interest group, all we're providing is the platform, but the individual must put forth some due diligence in regards to the type of real estate that they're buying. Does it have income that's coming in? Does repairs have to be done on it? And in some cases, if the person is not knowledgeable about these types of issues, they might want to pull in some experts that they can tap into in advising them as they perform their due diligence on an investment. Last but not least, ensure that plan and trust are in writing. In other words, these provisions, or in other words, that a plan has been set up that can actually accommodate this type of investment. In other words, if there are provisions in a document that is used above and beyond, for example, what the trust provides, make sure that the trust agreement or the documents that are used to establish the plan are in writing, and number two, spelled out as far as allowing these types of investments to be invested in this type of plan. Again, all this is saying is that as you enter into an individual 401k program, there are certain responsibilities that the employer must take on before they enter into this agreement, knowing fully well that these responsibilities do fall into the shoulders of the employer or the participant investing in alternative investments, as an example, real estate, precious metals, whatever it may be. Now, in an individual 401k plan or 401k plans for all intents and purposes, may be trusteed or custodied by an entity, or it could be what we call self-trusteed. Self-trusteed means the trustee of the plan is taking on ownership of the responsibility on where the investments are placed. In other words, an individual could sign a document with a little bank, ABC Bank as an example, but the employer could choose to put their investments in any organization. It could be at a broker-dealer, it could be at an alternative investment custodian, it could be at a bank. Therefore, the individual must also hold a checkbook that basically cuts the check to these investment providers, as well as, in some cases, distributions from the plan. Therefore, in an individual 401k plan, there is checkbook control. The checkbook must be under the name of the plan in order for it to receive or continue its tax deferment or preferential tax treatment. It can never be under the name of the individual. Why is that? The reason for that is this is still a retirement plan. The moment the assets in a retirement plan are paid to or made out to an individual, that is what we call a distribution. But an individual 401k plan, checkbook control is under the control of the trustee. Now, how do you invest in real estate in an individual 401k plan? First, you find a property to purchase, of course, assuming, of course, that you already have a plan established, and in this case, funded by whether it be a contribution or maybe even what we call rollovers from existing retirement plans that are out there already. You may have an IRA that you rolled over assets from a previous employer that could be actually rolled into an individual 401k plan to fund the plan, or maybe a direct rollover from another plan that you may have had that is eligible for rollover into the existing plan. So as you can see, there are many ways to fund an individual 401k plan, not only contributions. You can pour in existing assets from other types of retirement plans to fund your individual 401k plan. Again, find the property you would like to purchase. You could do this by yourself or seek assistance of a real estate agent or a broker that is knowledgeable about investors that use their retirement plan assets to invest in real estate. You, of course, would need to make the offer in the name of the plan. And in this case, ABC Company Profit Sharing Plan or ABC Company 401k, individual 401k plan. Now, in this case, whoever the participant is will be the name that would identify who is actually using their real estate, their retirement plan assets to purchase a piece of real estate. In this case, ABC Company Profit Sharing Plan for the benefit of Mary Jones, the participant, or John Jones, the participant. Now, the escrow is funded by the plan trustee. And if in an individual K plan, it could be one and the same person. Why is that? It could be ABC Company may be owned by Mary Jones or John Jones. Therefore, the escrow will be funded by the plan trustee by cutting a check, as an example, from the checking account of the plan to fund the purchase of a particular piece of real estate. The closing documents must reflect the beneficial interest in the plan. In other words, the ABC Company Profit Share Plan for the benefit of Mary Jones, who owns 50% of this particular piece of real estate, or John Jones, who owns 25% of a particular piece of real estate. The funding amount then is wired by the trustee to the escrow company, or a check may be cut. But for the most part, wires could be a vehicle used to send dollars to an escrow company. From then the escrow company closes the deal, and then the custodian of the plan or the trustee of the plan would hold a title or would hold the ownership interest under the name and for the benefit of the participant of the plan. Advantages of using an individual 401k plan to purchase real estate. Now, keep in mind, one of the things is that for the most part, it's nice to have the cash in the retirement plan to be able to use it to purchase a piece of real estate. And in 401k plans, there are larger contribution maximums, therefore allows an individual to bank away more cash into an individual 401k plan. An individual could also contribute cash or property to a 401k plan, whereas in other types of retirement plans, you can only contribute cash. You may also lease a portion of the property owned by your plan. The limitation, of course, states that it's only the only time you can lease a portion of the property that is owned by the plan if it's necessary to maintain that 401k plan by certain variables, such as there may not be another piece of property that it could be leased from to run that plan. You can also manage assets with a checkbook. You can take a personal loan from your plan. And also leverage property. In other words, you can actually borrow dollars to purchase a piece of property that is borrowed by the 401k plan. However, unrelated debt-financed taxation may occur. Let me give you an example of what that means. Let's say the plan the plan, let's say, only has $100,000 and they would like to borrow another $100,000 to purchase a $200,000 piece of property. That is what we call leveraging your assets in a retirement plan to purchase a piece of property. In other words, borrowing an unsecured or non-recourse, not unsecured, but a non-recourse loan to purchase a piece of property. Now, borrowing those dollars may raise up what we call unrelated debt finance investment taxation, typically associated with retirement plans, because you didn't have the money in the first place to purchase that piece of property. You had to borrow it. One of the beautiful things about an individual 401k plan is that it carves out qualified retirement plans from what we call UDFI rules. Under Section 514C3 of the tax code, although retirement plans are subject to it, qualified retirement plans, which an individual 401k plan is not subject to unrelated debt finance investments. That's one of the biggest advantages of buying a piece of real estate and using the borrowing strategy, because again, individual 401k plans are not subject to unrelated debt finance investment rules. Now, getting started. Open up an Entrust account. Fund your new account again by a contribution, a transfer, or rollover. And last but not least, instruct us, or the trustee could actually fund the escrow to purchase the investment directly. It's as easy as that. The reason why I say sometimes that, depending upon the document that you use, is because it may be that the document that is used to establish the individual 401k plan may be from a different provider instead of the Entrust Group, and I cannot speak for how their document has been written. So therefore, again, always check the document of what you can and cannot do, especially if it's not the Entrust Group's individual 401k document. In summary, an individual 401k plan is nothing more than a regular 401k plan, but by virtue of the fact that there are no rank and file employees, the limitations typically imposed in regular 401k plans do not apply. Individual 401k plans, again, are not subject to what we call non-discrimination rules. The eligibility and deadlines of an individual 401k plan apply to the type of employer that is establishing the plan. It has to be an employer, as well as the deadlines for when the plan must be established, which is the end of the fiscal tax year of the employer. The deadlines for contributions may also vary depending upon the type of entity that's making the contribution, since the deadline is up until the tax return due date plus extensions of an employer. There are your corporations, your partnerships, as well as sole proprietors. Again, the benefits of an individual 401k plan are larger contributions. You can also borrow from your assets in an individual 401k plan, which is up to 50% of your vested amount, not to exceed $50,000. However, there has to be some repayment that has to be made at least on a quarterly basis, and the amortization schedule cannot exceed 5 years. Other benefits of an individual pay plan include the fact that unrelated debt finance investment taxation does not apply to individual 401k plans, which most retirement plans are subject to. There are also responsibilities of participants in an individual 401k plan, such as if they are allowed to direct their investments, then they must do their own due diligence before they enter into a particular transaction, such as buying a piece of real estate. In an individual 401k plan, since the trustee may take control of the plan, in other words, it's what we call a self-trustee plan, there's checkbook control, but the checkbook has to be titled under the name of the plan. Now, investing in real estate in the 401k plan has its advantages. Again, checkbook control, the trustee can actually cut the check directly to fund the purchase of a piece of real estate, as well as, again, there is no unrelated debt finance investment issues in an individual K plan. And last but not least, we covered how to get started in investing under an individual K plan once it's established and, of course, once it's funded.